Hello.
Hello, can you hear me?
Yes. Yeah.
Just give me a minute. I will start sharing the screen, because if I share the screen, I lose the WebEx, the ability to see WebEx, and then like I'm totally
You are.
lost.
I've sent it to Yahoo, so I can
Yeah, I got
open.
it. I got it, sir. I got it. Just give me a second, sir. Just give me.
Okay.
Yeah, guys, can you see the screen? Because I am not able to see it.
Yeah, I can see it. Yes.
Okay, wonderful. Yeah, wonderful. Yeah, so welcome everybody, and so everybody probably knows me by this time, and then like my name is Ganesh Mani, everyone. We will quickly go through the housekeeping steps. I have everybody, thank you for joining us today. Please note that everybody is muted upon entry. You can always use the chat feature and Q&A area to ask your questions. Okay, and we will be sending a recording of the presentation to all the attendees today. And of course, regarding the CPE, everybody is expected to attend the full presentation and answer the 40 questions. By the way, there are 3 of them. And you also need to complete the evaluation form at the end of the session, which will pop in once you exit the webinar. Okay. And I'll just quickly introduce Mr. Raghu, the speaker of the day. I need to use this thing to read out. Everybody probably knows Mr. Raghu, people who are connected on LinkedIn and other places. Mr. Raghu is currently the head of research at Kuwait Financial Center, a leading asset management company based in Kuwait. Mr. Raghu, you are able to see, everything is going on fine, right? Because I cannot see the screen at the same time.
Yeah.
Okay, wonderful. And he is also the managing director of Marmor MENA Intelligence, a research subsidiary of Marcus. He leads a strategic research initiative at Marcus with specific focus on big picture research. He is also a voting member of the Investment Advisory Committee at Marcus. And he is a CFA charter holder. Way back in 2003, he got it. And he has been actively involved in the CFA Institute as a volunteer. He's a founding member of CFA Bahrain Society, founding member of Kuwait Society too. He's been there he was there on the Education Advisory Committee of CFA Institute between 2012 and 2019. He's a certified financial risk manager from the Global Association for Risk Professionals. He's a fellow member of the Institute of Cost Accountants of India, and he has also done his he has completed a 2-week investment management workshop at the Harvard Business School way back in 2007. Okay, and now we leave the floor open for Mr. Raghu. Okay, sir. Thank you. There you are, sir. This is all yours now.
Very good. Thank you, Ganesh. Can you hear me?
Yes, sir. Very well. Very well.
Very good. Good evening, all the participants, and sorry for this delay. The usual technology, that can go wrong sometimes. Murphy's Law. So better late than never. I will try to fast track my presentation to cope up with the lost time. Basically, the title itself, gives you a clue on what I am going to tackle as a topic today. I'm going to first, the presentation is probably split into 4 quick parts. Part 1 would talk about the COVID-19 pandemic destruction so far, and by looking at some interesting data points. Part 2 is to see while the economy got severely hit, the stock markets are celebrating. So we'll look at some data on um, the connection between, or the disconnection between the two. And then most importantly, the heart of the presentation, which is what can explain this grand disconnect. and how long this disconnect will continue, and which one will give in to which is the question that we are trying to answer in this brief presentation. So without wasting further time, let me move to the pandemic stat globally. As you can see here, it started very, very small, and now it's almost 37 million confirmed cases. Good news is nearly 26 million have recovered already. But we still, the world has witnessed more than 1 million deaths due to this pandemic, which was never the forecasted when it started way back in January, February. Rapid testing holds the key, and we have already seen that the world has tested about 557 billion. But for a global population of about 7 billion people, this is hardly moving the needle. So it started with China, as you can see in the table at the bottom. And China continues to surprise the world by reporting the lowest number of cases. While it started in China, the biggest hit has been taken by US with close to 7.7 million cases now, and more than 200,000 deaths. India is number 2 and Brazil is number 3. So the numbers are looking really alarming, and you can see the curve. It's not, while it looks like flattening, it's still not flattening yet. Moving on, we would like to see the same set of numbers for GCC. The GCC story, in my view, has been reasonably good. It's just a shade under 1 million cases with almost a similar number recovered. So they have almost 100% recovery rate close to, with only 7,600 deaths so far. And it's aggressive testing, really, really aggressive, 21 million compared to the population that we have in GCC. However, Saudi Arabia continues to have the biggest numbers in the game, primarily due to the population factor. But if you look at the density of the attack, which is measured better by the number of cases per million and number of deaths per million, I think Qatar and Oman shows a lot of weakness among GCC countries, with Kuwait following through. However, when benchmarked globally, it's not a very scary situation in GCC, so far under control as per this stat. Now, well, the whole discussion has been, as you must have been reading through, a lot of hopes on a vaccine development, which can bring some sort of a relief to the lockdowns and the stall of the economy. So everything has been, every attention has shifted to a vaccine development. Now, what is the real story behind this vaccine development? There is a beautiful article in New York Times that gives us some glimpse of what this vaccine development is all about. It's a 10-year-long process normally to develop a vaccine, and it has multiple stages, as you can see here, from the academic research to pre-clinical all the way to manufacturing, approval, and distribution. So this is typically how. So if you follow this typical pattern of a vaccine development, you're talking about 2033. So that's not a solution. So what are they doing now? If we move to the next slide, they're compressing every stage of a vaccine development, as you can see here. I mean, everything is now pushed to 2021, and what normally takes about a decade to achieve is now they're trying to do within 1 year. So in scientific terms, this is next to impossible feat. If at all they achieve, it will really deserve a lot of applause. So if we move further, so what are they trying to do? They're trying to skip the academic research part. They're trying to combine some phases. They're trying to build factories right now, even though it comes late in the stage. And augmenting the manufacturing in such a way that they can produce quickly if and when the vaccine is approved. So these are the things that they're trying to achieve. But how realistic is this is the question. So if we move to the next slide, we can see that actually only 10% of drug trials are normally approved. And if you see the past histories of vaccine development, starting the flu mist to uh, varicella to rotavirus, it took normally between 28 years to the fastest was mumps, which was about 4 years. But remember, there are three still prevalent diseases for which they haven't found any vaccine yet, which are the dengue, the Ebola, and the HIV. So COVID-19 can go either way. It can go to the top ones where they will find a vaccine, or it can remain a disease where you can never find a vaccine. So this is the story regarding the vaccine. Vaccine development is not that easy. So we would be now, Ganesh, if required, we can have the poll question.
Yeah, guys, I'll run the first polling question. In case people are not able to complete the polling question through that is, they're not able to see it on the devices, kindly do it to the chat window. That would be good enough for us. Okay. So right now, opening the poll. There we are. So, and we have around 32 seconds, 30 seconds. We are running it a little bit quickly so that we have more time for Mr. Raghu to speak. Oh, wonderful. Getting good. Oh, wonderful. Okay, 5 more seconds. 4, 3, 2, 1, and there we go. Sir. And it says that I have 1 more seconds. That's too good. Yeah, I will. I don't know whether I'm able. Sir, are you able to see the results by any chance?
No.
Okay.
How to?
Yeah, I'll share the poll results here.
Okay.
Yeah,
I
I
would
can see.
Mr. Raghu, could you were able to see the
Now?
results? Yeah, please, sir. Yeah.
Yeah, I can see the results, and I'm not very surprised by the results. So we'll move on to the next issue, which is the markets.
Okay.
Now, I'll explain the markets, and I'll explain the economy, and then I'll explain the disconnect. First, let's see the markets. Slide 17 shows that it's like a V-shaped market. You can very clearly see it's a huge fall, by a very quick recovery. March 23rd was the lowest point for markets. I think up to January things were quiet, and then in February things started ebbing a bit, and then the steep cliff-like fall and a recovery. Now, why this is a very unusual crisis from many points of view? If you just compare the two big crises that happened before COVID, which is the global financial crisis and the dot-com bubble, and before that the Black Friday, Normally, a bear market is recognized when you have a fall of 20% and more. So first they would count how many days it took for the market to fall by 20%. For global financial crisis, it took to 74 days, .com 353 days, whereas for COVID, it took only 22 days to achieve or drop by 20%. And it didn't stop there. It dropped further and it reached up to minus 34%. Now, if you look at the other crisis, it takes a bit of a time to fall and it takes even more time to recover. So that is typically the characteristics of a crisis. But here, this is a very unusual crisis where the number of days it took to fall, as well as the number of days that it took to recover, has been totally out of whack when you compare to the crisis that we have seen before. So when we move further and analyze the market, let's move to the next slide. So we are basically trying to see what is the correlation between markets and economy. So our periods of good economic performance correlate with the good market performance? Mostly, yes. If you can see the dots here, these are the quarterly correlation between economy on the y-axis and markets on the x-axis. So mostly, not every time, but mostly you can see that whenever the economy has done well, the markets have done well. But this time around in Q2 2020, you can see how skewed the correlation got compared to the normal correlation that we have observed since 2000, Q3 2000. So 2000 2020 is a long time period to consider, and this is absolutely unbelievable. Now, what is the disconnect? The disconnect is whether you take US or any other market. I have depicted here US, UK, Japan, and Germany. And if you look at the quarterly performance of the economy and the quarterly performance of the markets, up to Q4 2019, you can generally see that whenever economy does well, the markets do well. And then comes the inverse correlation where the economy tanks, the market zooms. So you can see this flip almost across the board for all the countries, US, UK, Japan, and Germany. So if we go down further and look at even the emerging markets, you can see the same pattern repeating for Brazil, Russia, India, but not for China. China, you have a good economic, decent economic performance with a decent market. So obviously, when looked at from an historical point of view, there is a very clear disconnect that we can see. So now let's try to see what the economic scene is like. Now, what is the first point of check to really see how the crisis has impacted the economy? Obviously, it should be the labor market, because when a crisis, and healthcare crisis like this hits the economy, when things come to a standstill, companies normally lay off people, and therefore that will get reflected in the jobs data or unemployment data. Now, unemployment, you have something called as official unemployment, and then you also have hidden unemployment. So while officially they can say that 10%, if you add the hidden unemployment, it's normally double that number that we are talking about. So the labor market presents a very ugly economic picture so far. And if you look at the valuation, because one of the best metrics of valuation is the market cap to GDP ratio, which Warren Buffett loves a lot. It always tells you if market cap moves ahead of GDP, you can clearly see a spike in this chart. Now, this spike is also because the market cap, which is the numerator, moves up, and the GDP, which is the denominator, moves down. So you have a double effect of an increase. So right now it is about 183%, which is way out of whack when you compare the history from 1975 in this chart. So obviously, it's a very stretched market on the secondary markets. And what about the primary markets? The primary markets, the IPO, is also at its hottest in over 2 decades. If you look at the data, for 2020 alone, so far over 95 billion has been raised in the primary market, essentially in key sectors like healthcare, technology, and what they call as the blank check companies, shell companies that are created for the purpose of acquiring a private company and taking it to the public. Now, even Warren Buffett is, attracted to this IPO mania that we are seeing. So clearly, the secondary markets are, uh, overvalued, and the IPO markets are at its hottest. So that sets the tone for the markets and the economy. So Ganesh, if you want, you can trigger the second polling question.
Guys, we have the second poll on 29. I don't want to keep saying the remaining time. We have a fairly active audience, so
Yeah, I can see
that. Yeah, it's been, the responses have been coming in quick, so really happy about that. But I think around 9 odd seconds, and I think we have around 10 guys who haven't responded. So we will give them 4, 3, 2, 1. Yeah, and thereabout. And I will share the results.
Okay.
Yeah. Sir, can you see the results?
Yes.
Oh, wonderful. Okay. Anything you feel is different from what you have been noticing so far? You would have done similar presentations everywhere, right? So you find people's moods have they changed?
No, I was expecting this sort of a response, and it's so far in line with what I've been seeing before.
Oh, okay. Anyways, we'll go back to the presentation.
Yeah. Now comes the most important aspect, which is to figure out this disconnect. What can really explain this disconnect? Obviously, the first factor is the huge swash of liquidity that the Fed and other central banks have opened the liquidity tap to mitigate the impact of the COVID. Now you can see that how money supply growth has literally skyrocketed during the last quarter to nearly 24%, and in US and in Europe and in England. So this clearly, this liquidity tap definitely has enabled the market recovery and the speed with which the market has grown. Now, the second factor that we can imagine is that markets are always forward looking, so don't worry about what happened in 2020. Now look at 2021 and 22, because that's what markets normally look at. So if you look at the IMF recent IMF data that was published last week, you can see for most of the economies, it's been a big recovery that they are forecasting for 2021. Now, one tale of caution here. The tale of caution is that these bright numbers that you see for 2021 comes on the back of negative numbers in 2020. So there is a low base effect, which gives this a false sense of comfort that 2021 is going to be much better, while it is really not the case because of the low base effect. And as finance professionals, we know the trick. So the third aspect is obviously the cost of money. While the central banks have opened the liquidity tap, they've also worked towards reducing the cost of money, which is measured through the yields. So now how do they do that? They do by aggressive purchase of securities. So when they purchase the securities, the price of the security goes up, and therefore the yield comes down. So On the one hand, they open the liquidity tap, and on the other hand, they keep the cost of money probably at its lowest point in its history, as you can see here. So when you, the most important argument made for the market frenzy is the lower cost of capital, because as finance people, we know that a firm value equation, which is free cash flow by 1 plus WACC, which is weighted average cost of capital. So if WACC comes down, you can see that the value goes up. Now, in the past, the WACC comes down, say, from 7 to 6%, so it doesn't matter. But now the WACC is moving closer to zero. And that probably means that as per this formula, value can be infinite. So when you're, dancing near zero, you are probably have to throw this formula out of window, because it's not going to make any more sense when WACC probably turns negative, as is the case in many European countries, as you can see. So you have liquidity tap, you have low cost of money and low cost of capital. And then the government also pushes through stimulus packages. Now, what do you mean by stimulus package? It's called the fiscal direct money that is being given, and other indirect measures were aimed specifically at elevating the impact of COVID on the economy. Now, it can be as high as Japan's 21% to as low as next to nothing for Mexico. But in general, most of the governments have thrown a lot of money behind the problem on the fiscal side. So on the monetary side, they brought down the cost of funds, they opened the liquidity tap, and on the fiscal side, they unleashed a huge stimulus packages. And it's not at over, because whenever they see signs of stress, they are ready with the next stimulus package. And the next argument, which is, why should markets be compared to the economy when they don't share the same structure? For example, the economy is dominated by finance, insurance, and real estate to the extent of 21%, whereas the market is dominated by information technology. So it's not that markets are very neat proxy for the economy. Markets are a very distorted proxy for an economy. So whatever happens to economy, it's for the economy, and whatever happens to the market, it's to the market. So there is a polarity in terms of the comparison between economy and the market. So don't worry too much about comparing economy to the markets. So that's another argument that is being given, and which is also true in the sense that if you look at the performance of what they call as FANG stocks, like the Facebook, Amazon, Apple, Microsoft, Google, they have gained about 58% in the last 12 months, compared to just 1% for the rest of the S&P 500. So clearly, the markets are rallying, but not the broader markets, but the narrow market of technology, healthcare. This is what is rallying, not the broader market. So there is a bipolar rally. It's not a all-pervasive rally. And then we also have seen a huge rush of retail investors, as you can look at the data of new account openings. And also, if you check the number of Google searches with the terms like day trading or call options, they have significantly spiked during the last few months, probably because people work from home and therefore they have some time on hand to dabble in stock markets and make some quick money. So, this is another reason that is fueling the frenzy, according to some experts. So you have a multiple combination of reasons as to why markets are partying when economy is in doldrums. So that opens up our third polling question, which is, which factor do you feel has contributed most to the disconnect between market and economy? On to you, Ganesh.
Yeah, I will just open the third and the last question for the day. Guys, you have the third question on. And in case you are hearing anything on the background, that's because I am at home. Please forgive me. I'm waiting to see if somebody says, how many of them say D, I see no disconnect. Guys, you have few more seconds, so anyone who is like away, there are like around 12, call it those 12 guys. Oh, wonderful. Mr. Raghu, yeah, that's I hope you're able to see the polling results.
Yes, yes.
Okay. So,
This
any
is,
comments
yeah, this is a bit
different from what has been said so far?
absolutely.
Okay.
Yeah, it's very interesting to watch, actually. Very
Okay.
good. So
We
let's
will
move to
probably,
last
yeah, we will go to the next one. Yeah.
last part of the presentation, which is the way forward. What can be the scenarios? Of course, we have seen a grand disconnect between the markets and the economy, but how is it all going to play out? Now, this is definitely a scenario analysis. It's very contingent on a vaccine coming effectively in 2021 for the most optimistic scenario to unfold, but also that it's not a uniform comeback. There are some sectors which will come back in the first half of 2021, like telecom, healthcare, and sectors like that. But there are some sectors, like, for example, airlines and cruises, which will never come back before 2023. So today, there was an interview that I saw from IMF's Geeta Gopinath, who says that a recovery is possible only by 2023. So there are many people who do not subscribe to the view that 2021 would mark the recovery and the jump from an economic perspective. Many of them are factoring 2023 as the, I don't know if it is a pessimistic, but a realistic call to look at. So now, definitely how companies would respond to this long stretch of recovery. So you have on the one side a demand destruction, then on the other side you have the supply chain disruption. So you need to set right both for things to come back to normalcy. So you have to bring the demand back and you have to set right the supply chain disruptions. Till that happens, now that can take a year, it can take 2 years, 3 years. Till that happens, companies would respond by cost cutting and deferring capex or planned investments. Now this will be maybe the cost cutting will directly result in job losses, and lack of capex will mean a lack of trigger for earnings growth. Now we can also expect a lot of M&A because you will find distressed companies around. Now the uh, lack of planned investments can be augmented by the government by pushing their investments ahead of the curve, and that can partially contribute to the pullback from the corporate side. But cost containment in terms of job losses, I don't think the government can fill that problem through rapidly giving employment to people. So rethinking the supply chain, in my assessment, can be a long drawn process. It's not easy. And many of the countries are trying to turn inwards now to fix the problem. They try to curb imports. And when you curb imports, you're automatically curbing exports. So in a free trade world, you have to be a free trade partner to make things work on the supply chain issues. So if you're more and more inward looking, it's going to only precipitate the problem and it's not going to make things better. So the scenarios are quite in my view, 2023 is the call when things can get normalized. So, parting words from my side, definitely there is a divergence, huge divergence between what you see on the ground and what you see in the stock market as a signal. We know that stock markets are forward looking, and we know that it's a very polar rally, and we know that it's not structurally comparable between markets and the economy. But having said all, we have to, at the end of the day, the reality should catch up with the market exuberance, in my view. So there must be a convergence. Either the economy should surprise everyone through more than expected recovery and justify the market premium, or the market should pull back and justify the economic weakness. So one of the two is definitely given. But in my assessment, I think a market pullback is more possible than an economic recovery because of so many known unknowns and unknown unknowns. For example, you may have another round of lockdowns if there is a second wave of COVID. You may have a problem if vaccine development fails to live up to the hype, which more likely is possible. You may have a problem when you see actual data on NPAs coming from the banking system. They're yet to start in terms of showing up. You may have other surprises like the US election uncertainty, where there is a very tightly fought election, then you have policy uncertainty from one of the largest markets in the world. And there could be so many things that can really cheese off the market in no time. So I would say that this is the biggest crisis that we have ever witnessed in our lifetimes, which has destroyed both the demand as well as the supply. We have seen the V-shaped recovery in the markets, but we haven't seen the V-shaped recovery in the economy yet. The hope is that it is also a V-shaped recovery. The hope is that things will come back to normalcy in 2021. But it is better to be safe than sorry. That could be my parting words, actually.
Yeah, thank you very much, Mr. Raghu. And I hope you would be able to stay back for some more time to just see whether some of the participants, if they have shared questions.
Absolutely.
Polling.
Yeah, sir, we are skipping the fourth polling question.
Yep.
We are just keeping 3 because of the time pressures, and Mr. Raghu enough time to have a look at. I'll just go through the chat to see, if anybody has anything. I think people have been more around asking questions about the options. Because I'm a consultant right now, and I'll just quickly try to squeeze in a question for my own benefit here. Free advice if possible. You showed a slide about how the DCF is going to really get whacked out of shape. The valuations will not be there. Would you want to expand on it further as to like how and what could be probably done? Because valuations, how do you look at it? Is there something else that can be done? I don't know, is there a method available, or you would want to do some kind of factoring or something of that sort?
No, actually, the equation is pretty simple. It's free cash flow divided by 1 plus R. And R is your cost of capital. And as cost of capital converges to 0, you have a very, explosive valuation in front of you, which is unsustainable. So the cost of capital should go back, in my view, in tune with inflation concerns. Now, it's anybody's guess. It's very two variables that people have never been successful in forecasting are inflation and interest rates. So it will be a big hazard to guess the direction of these two. But right now, the companies are enjoying unlimited valuation only because of a very low R. So if you are an investor, and if the R comes down and the valuation goes up, that means your P ratio would be astronomical, actually. In many cases, we have seen that the P ratios are making no sense anymore. So now people have started talking about be price to sales ratio, not price to earnings. And even here, I find that, for example, a company like Zoom has a price to sales ratio of about 86. 5 to 10 is the norm in the industry. So 5 is very reasonable and 10 is a stretched price to sales ratio. So you're talking about 86, 100, this type of valuation only because of the distortion in the cost of capital market. So definitely these are not times to just plug in the value in your value equation and try to get some numbers around and feel the false sense of comfort, basically.
And one more question. You would have seen, you would have anything to share or comment about how the GCC markets have performed vis-a-vis the rest of the countries?
Markets haven't exhibited a V-shaped recovery like how US and other emerging markets have exhibited from a stock market point of view. So it's more of a, it fell and then it is struggling to get back, so types, which is how it should be in a correct context, especially for a one commodity dependent economies like GCC. This is very true because oil prices are at their lowest point, and GCC economies face a lot of other troubles as well in terms of increasing deficit and increasing government debt, and therefore the markets have struggled to get back. So it's not a V-shaped recovery in GCC, nor we expect a V-shaped recovery in GCC.
There is one gentleman, Sameer Ahmed, who had asked a question. While I didn't get, he has used a short form RRR for new projects to consider. How can we adjust the RRR for new projects to consider the risk impact of COVID?
Yeah, that's a good question. He's talking about the required rate of return.
Oh, okay. Okay.
Yeah, required rate of return again is a function of risk premium, and what return you must demand in this scenario while doing project evaluation. And again, when the WACC equation, if the RRR is low, then your project value shoots up. So obviously, how do you calibrate the required rate of return which the investors should demand? Now, if you ask me, because of all the uncertainties and so many known unknowns and unknown unknowns, I think the required rate of return technically should go up. You will have a stable RRR only when you have a very stable economy and you can have reasonable forecast that you can rely on. But if you look at every week, the forecast keeps changing, and the every month the narrative keeps changing. So just to cover yourself, I think the only way you can be smart is to jack up your RRR, actually.
Yeah, Sir Babu, you can go ahead and unmute yourself, and I think you have a question for Mr. Raghu.
Hello, Mr. Raghu. It was a nice presentation from you, and yeah, you said for getting a complete vaccine, it would take 10 years. Then how we can think that the market would stabilize in the first or second quarter of 2021?
Yeah, the market stabilization is from an economic recovery point of view. So the fallback or fallout of COVID, the solution need not just be in vaccine. The solution could be, say, aggressive testing and learning to live with the virus. Because even if you invent a vaccine successfully, and even if you roll it out in 2021, very unlikely, but assuming you can do it, imagine the time it will take to vaccinate 7 billion population of this earth. It's going to be a very, very long-term process. Even if you start vaccinating from tomorrow, it's going to take at least 5 to 6 years for you to finish vaccinating the entire globe. because the manufacturing of the vaccine and the delivery of the vaccine has to keep up with the huge number of people that would have to be essentially vaccinated. So vaccine is not probably the only solution on site. So there are many other ways to tackle this virus, including learning to live with it through social distancing and making sure that you don't spread it and things like that. And then, probably these type of economic recovery calls, even from IMF, are predicated on this assumption that there is just no only vaccine solution to the problem. There are other solutions to the same problem. So that is and also remember the recovery number that you are seeing there is on the back of a negative base. And any small recovery will look very big because your base is actually very negative. So you have a low base effect, which you need to. So actually what you have to focus on is the recovery number that they are telling you for, say, not 2021, but 2022. Because 2022 will not have the low base problem, and that would be a more meaningful number to look at than 2021, which will get distorted because of the low base problem.
Thank you.
Most welcome.
Yeah. Mr. Raghu, one last question before we end this presentation. You by virtue of your position, you would have you would be getting an opportunity to see both private markets as well as public markets. You discussed in great length about the public markets. You have seen anything in the private markets, that in the private equity or in the other asset classes, if there have been similar response, or has it been different?
No, it's the same, because liquidity will, it's a liquidity gush, and it flows into all asset classes, public markets, private markets, commodities, gold. So wherever the liquidity can find, it will go and pop up that market. Private market is actually nothing but an adjunct of public markets, right? And whenever public markets do well, private markets also do well. And the private markets currently is sitting on unbelievable loads of cash, and they are behind the major M&A boom that you're seeing now. And obviously the frenzy is not only on the secondary markets and IPOs, but is also equally on the primary private market, which I didn't cover, unfortunately, in this presentation, but it is very much the case.
Okay, sir. Thank you, Mr. Raghu. Thank you very much. And thanks to all participants. Okay, we really started late. Sincere apologies from my side. And thank you everybody for your patience and kindly listening to Mr. Raghu, and because of certain things which we would have probably speeded up the presentation here and there, forgive us. Okay, thank you very much. I'll end it right now. Thanks, Mr. Raghu, and to all participants.
Thank you.
Have a nice evening, and a weekend, great weekend.
Thank you.
Thank you, sir.
Stay safe.